When you hear index funds, you probably think of simple, low-cost investments for everyday people. But here's the twist. Ultra-wealthy investors use index funds in ways most of us don't even realize. It's not just about buying and holding for decades. They leverage time and tax strategies that maximize returns and minimize risks. Today, we're diving into how rich people really use index funds and why it's not what you think. Ready to rethink everything you know about investing? Today we will talk about how rich people use index funds. It's not what you think. So before we start, make sure to hit the like button and subscribe to my channel. Strategic selection, beyond basic index funds. Most people think index funds mean buying a broad market fund like the S&P 500 and holding it forever. However, wealthy investors use a far more nuanced approach. They select from a variety of index funds, sector-specific, international, small-cap, dividend-focused, or thematic funds, to build a highly diversified and customized portfolio. This strategy allows them to tailor exposure to specific parts of the market, balancing growth potential with stability based on their individual goals and risk tolerance. Instead of blindly owning a single index fund, the rich mix and match multiple funds to optimize returns and reduce risk. Their approach involves active decisions on the types of indexes they want exposure to, often based on deep research or advice from expert financial managers. This deliberate customization differentiates their portfolios from the typical one-size-fits-all advice many investors follow, giving them a strategic edge. Tax efficiency, minimizing the tax drag. One of the most powerful tools rich investors use with index funds is tax efficiency. Taxes can significantly reduce investment returns, especially on dividends and capital gains. Wealthy investors place index funds in tax-advantaged accounts such as IRAs, 401ks, or trusts to shield these earnings from immediate taxation, allowing their investments to compound faster. They also engage in tax loss harvesting, selling index funds at a loss to offset gains elsewhere while reinvesting in similar funds to maintain market exposure. This method effectively reduces taxable income and boosts after-tax returns over time. Many average investors don't fully utilize these strategies or misunderstand how to implement them properly. For the rich, tax management is a continuous process and a vital part of their index fund strategy, enabling them to keep a larger portion of their gains and accelerate wealth accumulation. Tactical rebalancing, active management of passive funds. While index funds are often promoted as set-it-and-forget-it investments, wealthy investors actively rebalance their portfolios. Rather than rebalancing once a year or less, they monitor market conditions and adjust allocations to maintain their desired risk exposure. For example, if a particular sector grows significantly and overweights their portfolio, they may sell shares in that sector fund and buy into undervalued areas. This careful management ensures the portfolio stays aligned with their long-term goals and prevents unintended risk concentrations. Additionally, rebalancing can lock in profits from overperforming assets while increasing exposure to cheaper ones. This disciplined, tactical approach to managing index funds maximizes returns while reducing risk, something the typical passive investor often overlooks or fails to implement consistently. Multi-asset diversification. Index funds as a core, not the whole. Wealthy investors recognize that index funds alone cannot provide complete diversification or optimal returns. They combine index funds with other asset classes such as private equity, real estate, bonds, and alternative investments to build a robust portfolio. While index funds offer broad, low-cost market exposure and liquidity, other assets provide opportunities for higher returns and lower correlations to traditional markets. This multi-asset strategy smooths out portfolio volatility and helps protect wealth during economic downturns. Rich investors use index funds as the foundational core of their portfolios, but strategically complement them with specialized investments tailored to their unique objectives and risk profiles. This combination ensures they can capitalize on diverse sources of growth while managing overall risk more effectively than simply relying on index funds alone. Smart fee management, quality over cheapest option. Index funds are famous for their low fees, and the wealthy definitely take advantage of this cost efficiency. However, they also understand that the absolute cheapest fund isn't always the best option. They may choose funds with slightly higher fees if those funds offer better tracking accuracy, liquidity, or access to niche markets that fit their strategy. Furthermore, affluent investors often gain access to institutional share classes or direct indexing platforms, which provide even lower costs and enhanced tax benefits unavailable to most retail investors. This careful evaluation of fees versus benefits allows them to maximize net returns over time. The rich view fee management not just as picking the cheapest product, but as balancing costs with quality and strategic fit, a subtle distinction that improves their investment outcomes significantly. Liability matching and cash flow planning. Rich investors often use index funds in creative ways beyond just growth, specifically for liability matching and cash flow planning. They construct portfolios with an eye toward future expenses, such as college tuition, major purchases, or retirement withdrawals. By creating a glide path strategy, they gradually reduce risk exposure in index funds as those spending dates approach, minimizing the risk of needing to sell during market downturns. This dynamic adjustment transforms index funds from pure growth vehicles into tools that align with financial milestones. This approach ensures that funds are available when needed, smoothing out cash flow and reducing uncertainty. Many average investors overlook this planning element, but for the wealthy, index funds become an integral part of their comprehensive financial strategy, balancing growth with liquidity and timing needs. Behavioral advantages, patience, and discipline. A critical advantage wealthy investors have when using index funds is behavioral. They maintain patience and discipline during market volatility. Index funds' broad diversification and transparency make it easier for investors to avoid panic selling during downturns or chasing hot sectors during rallies. The rich recognize their emotional triggers and use index funds as a psychological anchor, sticking with their long-term investment plan despite short-term noise. This steady approach often leads to better long-term returns, as market recoveries reward disciplined investors. Many average investors, in contrast, are prone to emotional decision-making that undermines their gains. The ability to stay calm and committed to a well-constructed index fund portfolio is a subtle but powerful factor in how the rich consistently grow their wealth over time. Legacy planning and wealth transfer. Beyond accumulation, wealthy investors use index funds strategically for legacy planning and wealth transfer. They hold index funds within trusts or family investment vehicles, which simplifies valuation, reporting, and the transfer of assets to heirs. The liquidity and transparency of index funds make them ideal for this purpose, enabling efficient estate management and smoother wealth transitions across generations. Additionally, tax-efficient index funds can minimize estate taxes and capital gains taxes upon inheritance, reserving more wealth for beneficiaries. This thoughtful use of index funds as part of a comprehensive legacy plan ensures that wealth endures beyond the investor's lifetime. For many rich families, index funds are not just tools for growing wealth, but also vital instruments for safeguarding and transferring it to future generations. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.